Good afternoon. It is always bad for someone to pick up after lunch. And this morning when I woke up, I found a little note on my bedside. It's better to have slept and snored than not have slept at all. So if anybody has a desire to sleep and snore, please go to the bed. We started out with a workshop on basically in consumer related issues, and we then migrated to commercial credit, and then followed by a track which dealt with issues like big data, cybersecurity, and the like, which impacts all of us. And now we're ending up full circle back on consumer credit, and we're basically dealing with issues, with policy issues, and basically operational issues. We have an excellent panel again, which our moderator will introduce, and we had Tony Hadley on Thursday. I don't think he does need a great introduction, but for those who weren't here Thursday morning, Tony Hadley is Senior Vice President for Government Affairs and Public Policy of Experian, and I think he's one of the most softly spoken representative of the industry. Keep it up, your good work. Thank you. Please welcome Tony Hadley.
Soft spoken, what does that mean?
Your credit is probably not good.
Thank you. So welcome this afternoon to our panel. We're going to be talking about key business and regulatory issues in the consumer credit reporting marketplace. Welcome. And yeah, it is after lunch, so I'm feeling the same way. I'll try to liven things up, get a conversation going here with my fellow panelists, whom I will say, I'm so pleased to join me. We've got some real experts here. Now these are people that you probably well know in the industry already because their reputation exceeds themselves. One of the things that we did when we planned this is we thought, let's collectively think about what the key issues are that we'd like to discuss today. And we picked out 5 of them. The first topic we're going to talk about is consumer education, financial literacy, and transparency. It's an issue that all economies, all regulators, and all businesses are trying to deal with. The second one is data quality and integrity. Another issue that's chief on the plates of both business and regulators, right? We're going to talk about the regulatory oversight of credit bureaus and some of the imperatives that we're seeing regulators want to achieve in the credit reporting space. We're going to talk about credit risk, credit scores, and big data, and how that plays into the business imperatives and the regulatory environment. And then finally, we're going to talk about data reporting and alternative data as ways of enhancing financial inclusion, because that too is an issue that is a business imperative and one that regulators are closely watching and want to be involved with. So before we start, let me introduce my panel, in case you don't know them. I'm going to start over with Michael Turner, who is the founder, president, and CEO of the Political and Economic Research Council, which we call PERC, known to many of us. He's a prominent global expert on credit access, credit reporting, credit scoring, information policy, and economic development. We're really happy to have him today. Next, we have Peter Villa. He's Chief Operating Officer and member of the Management Board of Schufa of Germany, right? The credit reporting agency there, just dominant. Peter's responsible for operations and international relations, and he's a director of the BIIA. Then we have Lawrence Song, who is president of TransUnion's East Asia operations, responsible for growing TU's credit information and analytics and decision business in the region. And Lawrence is also a director of BIIA.
Yes, thank you.
Then we have Enrico Lodi, and he's general manager of CRIF, leading credit bureau. And he's headquartered in Bologna, Italy. He's first vice president of Access, the European Association for Consumer Credit Information Suppliers, and is also director of BIIA. So we have all these prominent people here. And then finally, we have Dr. J.C. Parenas, who's coordinator of the advisory group for the APEC Financial System Capacity Building. And that's a coalition of major public and private institutions and interests affiliated with the APEC Business Advisory Council, and it aims to promote development of the region's financial markets and industry. He's been a big leader in APEC regarding the development and the promotion and the capacity building associated with credit reporting around the region. We're very proud to have him today too. So I'd like to start, yes, absolutely. Yeah, I wish I had a resume like these guys. Maybe one day I will. I want to start out with a topic that I think is interesting and important right now, and it really goes to the consumer education, financial literacy, and transparency of credit reports. It just seems to me, to put it in context, that the transparency of credit reports to consumers is a chief leading issue for businesses. That is, how do they understand what's going on, but more importantly, how can they take that information and understand how to use it in their life to better improve their credit report? And do they know what's going on with their credit report and how important it is to them? You know, it seems to me that one of the things we're seeing from a business perspective is that can be a profit center for credit bureaus, helping consumers understand how to better access, use, and improve their credit scores. I'll talk about that and how Experian is doing it in a minute, but I'd really like to turn it over to Peter to discuss it and what he thinks the major movement is, or trends in the area of credit education and financial literacy, because he's a leader here in the credit reporting industry, because SCHUFA has introduced a major financial literacy program really in cooperation with the central bank. And so I'd like to turn it over to Peter, and what I'd like to ask him to do is start out by just talking about some of the things they're doing, some of the imperatives that they see in this marketplace, and then we'll create a dialogue with the other panelists and the audience. I want to make you participate, call on you if you don't, and we'll try to keep a dialogue going about how we can learn how this can be even a bigger imperative for us, while addressing regulatory issues around the same issue. So Peter, why don't you take it over?
Thank you, Tony. I mean, I want to just give you a story how it works in Germany. I take this example from our company, SCHUFA. SCHUFA has a brand recognition in Germany about 96%. It's very, very high. So people know the company. But we asked some years ago, for what is SCHUFA known on the market? Do people understand what SCHUFA is? And we were quite surprised. People knew SCHUFA, but they didn't know what the credit bureau is doing. And we couldn't get people really to understand. And if people don't understand in the market, you always have the issue that you have assumption, and most is wrong assumptions. So we said, okay, if we want to we will have to do something, because if you have a negative kind of feeling of a credit bureau in a country, you will have political kind of pressure on that as well. So we started with consumer education. We thought about that, who is to reach? How can you reach people? And where we wanted to reach was to reach young people. Young people can still be open for what we're doing. So we have some different things, and I'll give you some kind of brief introduction. I even have some print form with me so you can take a look at it. First of all, we start to say, okay, if you want to reach young people, we have to do something for the schools, for high schools. So we created a package for teachers and for the schools, where we have some points, not only financial education thing, but you will recognize what things, how can you start up a company, bucket list, if you want to lease a car, whatever it was. Some really useful kind of material. And we pushed that, and it was like a package like this. So we still send it to print from to the German schools, and you have it electronically as well, with all the things you need. And it's well received, and we try not to push SCHUFA so hard. It's more to push the item that people understand why you need a credit bureau, why it's important for the society. And we do the same thing on the web, so you can go in, you can look at it on the web. We have done it for pupils as well, so it's very easy to understand. It's a bit funny as well. And that's been very successful, and we have a lot of dialogue. We're out at the schools. It really helps to have understanding what's happening. We're promoting different schools as well, if they have activities. respond to that and try to have some kind of dialogue with different schools out in Germany. And I think it was a good way for us, we have this couple of years right now, it was a good way to get a better understanding. And what we did, we tried to be in the background, not push the brand so hard, trying to push really good materials. And we didn't do it ourselves. We had professionals with us doing this package. I think it's very important. So it really has some standard as well. That's one other point we have. Of course, we have a code of conduct, and one thing we try is to create trust in Germany. We've been this in 1927, and it doesn't help us with this package. We try, what could we do more than this? And one thing we thought about was, of course, people always were insecure about scoring and what scoring is and how it have impact on their life. And you know, we are using scoring, and people tend to have a negative kind of view of scoring. So we started a project called Scoring Knowledge, Scoring Online. We're really trying to explain what scoring is, how it works, what criteria are important for people. And I think it's a good package. Still, it helps a lot, it doesn't help everything. You know, in Germany we had a court case in the highest court where people really pushed that Schufa should open their algorithms. What we happily enough, we didn't have to do that. But still, we know we have to do much more in scoring to get people to understand scoring, what it is, and how they can help and how we can provide a service in that field. Another thing we did is we created an ombudsman, and that was idea some years ago. We said, okay, if we will come to court cases and we have a debate with customers and consumers, it will be very tricky to handle this. And we want to take it out from the court cases, we want to take it out at another kind of level. So today we have a former president of the highest court in Germany, Professor Papier, who is the ombudsman of Schufa, and that's really helping because if we say something, people will not listen, but if he says something, people listen. And I can give you one example. I mean, we have, and you have to be entitled to have the case by the ombudsman, and it's not a legal format, but it's almost working like that. We had around 500 cases last year by the ombudsman, who was permitted to go to this way. And 18 cases were proven that we did mistake. And you know, we're in the industry right now, mostly it wasn't we made a mistake, it was the partner we had, the data we had. And that by over 120 million transactions, that's quite okay. It helps, and he is even publishing every year, I have to show it as well so you believe me, a written report from the Schufa Ombudsman, everybody can access. You can see what's happening, the court cases, things like that, and we publish that for free as well. It gives us some positive press as well. I think it's quite good to have. Then we have another publication, and I show you all the publications today because I brought them here, so I have to show them as well. It's what we call the Schufa Credit Compass. And we had this in 2003. And what we have here is a lot of statistics. And statistics are quite good to have because you can show some good cases. Over-indebtedness in Germany, you can show it by region. We have different themes. We had theme young people, older people. This last year we had people, the lifetime travel as a financial participant in society from young people to older people. And that creates a lot of press, and we have a lot of good debate with that as well. So when we look at this kind of consumer education, we don't only look at that as something for the schools, we try to have different kind of activities. Another activity we have is we have a parliament evening in Berlin every year. We invite the ministers, people from the parliament. We try to catch them with some good dialogue, different things we can discuss every year. And it's been quite okay, it works. Still, we have to do much more, we know that, but we also know this is an investment, it costs a lot of money, of course. But we see it as a good investment because we have a better standpoint in the German market if something happens. And something I forgot to tell you, have a consumer board as well. And that's a tricky thing. I think a lot of you probably have the same consumer board because you can't control them. So we have people from politics, you have people from the consumer organization in Germany, you have academics as well. And what we do, if we have a new product or some issue, we start to have a dialogue with them before and test this product. But then you have to be aware of, if you do that, they can say no. And if they say no, you will go out and market anyhow, you will have issues. So that's something you have to correlate with. But I think it's very important for us, at least in Germany, to work with this kind of dialogue with the consumers, with the markets, so people understand what we're doing. And we have to do much more, we know that. We're trying to be in a dialogue and not in television program, but we're trying to be in the media if there is something in this sector. So just go on this kind of discussion. I know it's very different in different market, and we were probably not the first one doing that, because when Schufa started this one, Schufa looked at our colleagues in the market and see what they did. But maybe I can push the question to my colleagues in this one, in this round. I mean, as we are doing this Schufa as a private owned by the German banks, credit bureau. How is it in your markets? If I go around on my colleagues here.
Maybe sharing some interesting examples in Asia Pacific. TransUnion is actually developing two scores, one for Thailand market and then the other one for Singapore market. And basically it's a industry risk score for the two leading credit bureaus in those two markets. And one of the processes that we encounter this year is that we need to talk to the central banks about the score. So not just about the score, it's actually the methodology and also the sampling we use to develop the score for these two markets. And more important, the regulators are requiring us to also do a third-party validation to make sure the scores are performing, able to predict the delinquency for those markets. So I think in the Asia Pacific space here then, not just we need to be more transparent about our score to the consumer, the regulators are now getting more focus on how the score will impact the consumer. And that's why they are really very concerned whether the methodology we use, the process that we're going through are really up to the international standard to make sure we predict the score accurately in the industry.
Very good.
I mean, give it to Enrico as well. I mean,
Well, in example, European example, another country, Italy. One, the regulation says that lenders, when they do not grant a credit line, they have to explain why they did not. Then we have to provide our customers, for example financial institutions, with the so-called score factors. Second, Basel II made as a requirement for lenders to, let's say, track and document how the internal models are built up. And when the internal models include also the external information, for example, the information retrieved from a credit reporting agency, as well, the bank has to qualify this, and again, we have to disclose the score factors. This is just a couple of examples. Then transparency is already in place, not only because we want to be transparent, but also because the regulation in place requires this.
Good. You know, one of the things that I thought might be important for you to understand is how Experian has monetized transparency, consumer reports, and credit scores in the United States. We have a subsidiary called Experian Consumer Services, where we have a direct relationship with consumers. This is different than our credit bureau that has a relationship with businesses. But the revenues now from Experian Consumer Services, it's selling credit reports and scores directly to consumers, now is equal to the revenues we derive from selling consumer reports to lenders. It's a big business. And it's a business that's developed even though we didn't expect it to. This all started about 15 years ago, about 12 years ago, when the US Congress told credit bureaus that they had to give a free credit score, a credit report away to consumers upon request. We thought, OMG, what's gonna happen? They're going to drive free credit reports through the sky, and we won't be able to respond to them. We'll lose money doing it. Instead, what it did was sparked a real interest in consumers about credit reports and its content. Then suddenly they were interested in how that credit report related to their score, and how their score related to the price of credit that they were trying to obtain. And through this curiosity then, we were able to begin developing and pushing out new products and services like credit monitoring, alerting people to changes in their reports that were really a fact of a fear of identity theft in many respects. We found a big market for those who were wanting to get an automobile in a few months or a home in a few months, wanted to see how their score looked and how they could improve it over a few month period to get the best price on credit. We have identity protection services, and now there's a huge number of scores being disclosed in the United States, even by lenders voluntarily. I would think that my last estimate is that 280 million credit scores are disclosed to consumers free every year. And so now that's bringing a new opportunity to Experian. It's not what is my score, what are the factors that led to my score, and who derived the score. The questions now are, how can I improve my score? So this is a new business opportunity that we're seeing within the US credit market by answering and giving advice to people on the steps and the behaviors that they can take in order to understand how they can get the best possible score given their circumstances. We have the ability, we're trying to move those onto online devices to be on your phone, right? And connect consumers more directly with their credit reports and their credit reports, as well as giving them counseling sessions and whatnot. So I think there's ways to look at transparency, credit scores, and credit reports in a way that not only benefit consumers, bring more transparency to them, connect them to their credit life, but also in a way where you can drive profits and revenues.
So interesting that this trend also happens in Asia Pacific. Tony mentioned about the US trend, but it so happened over the last 3 to 4 years. Hong Kong, Singapore, Thailand, and also Malaysia, they're also looking at all these direct-to-consumer initiatives. Hong Kong, we see the demand for consumer report, not just for the traditional, like how to manage my finances. We also look at how we create value through the consumer report for identity protection. And over the last 2 years, actually a lot of consumers in Hong Kong are looking for the report for employment referencing. A lot of multinational banks in Hong Kong actually requiring their candidates, kind of like the shortlist candidates, kind of like sensitive position to get a credit report to actually show it to the employer to make a final decision for the recruitment. So employment referencing seems to be a new value of consumer report. And we also got guests here from Thailand, NCB, and also from CBS. They are also embarking on the direct-to-consumer journey, educating the consumer through school roadshows, online channels, and also cooperation with banks to educate the consumer. So I think this trend of direct-to-consumer business also represents an opportunity for the credit bureaus here in the Asia-Pacific market.
I'm sure your view on this one. I mean, you're not directly involved in consumer report, but what's your view on it?
Well, I'm going to be speaking to aspects of this a little bit later,
Yeah.
so maybe Lauren's pointed out some of the other folks in the audience, maybe some of the other bureaus in the audience who have financial literacy or consumer education initiatives might want to share what they're doing.
Yeah, that would be great. Maybe, Neil, you could talk about how direct-to-consumer products are being taken up in Europe and in that area. Would you mind? I told you I was going to call on people.
I'm going to pose a question as well, actually, because this is something which came out of the World Bank work, which is, this is a credit reporting system, and a system means there are a number of different players. And we've talked very much around actual what credit bureaus do, but I think a lesson for those of you who are developing credit bureaus, and it's still challenging in the Western world, is actually how do you get the other players in the system to educate? Lenders, regulators even, and I think that it would be good to share experiences around that, because everything comes back to the credit bureau, and that puts the credit bureau in a negative position a lot of the time. A colleague of mine once said, you know, credit bureaus are the customer service centre for the banks, which is what happens because they get turned down, they don't get told why, and they come to the credit bureau. So I'd be interested in experiences around that one. What was the original question? I bluffed it out.
Just how direct-to-consumer products and services are going over in Europe and how they're being.
Yeah, I mean, in Europe,
received.
Europe is along the lines of the challenges we've got. I mean, there's a lot of development of direct-to-consumer, and I think there's a change in focus in that. I think it was seen as a revenue opportunity. I think people are thinking a bit broader about it now, knowing that it is an education point. There's plenty of education that's going on in schools, so it mirrors very much like what Schufa's been doing. But I think the work that we're doing now is turning to engaging everybody. So it's back to my question really. It's about, you know, working with lenders, you know, getting them. I mean, in the US they do lenders release scores, as you mentioned, and I think that'll happen more in Europe as well. Tricky because there's not one FICO score in Europe, of course, where you do have that in the US, but I think that will come along. And I think I think we're working more and more with regulators. You know, getting a regulator to produce an item. I mean, there's a very good booklet in the UK that the Information Commissioner, the Data Protection Regulators issue, which is explaining, you know, it's getting credit. And that tells you about what credit bureaus do and what they don't do, more importantly. And that's quite important as well. So it's growing. But I think it's changing, and I'm hoping that members of Axis will change in their approach. See it as a revenue opportunity, but also think of it a bit more longer term about where it is. Because I think longer term, if I'm being very frank, there will be a challenge to the commercial model. There's a number of regulators who will say, so you're charging how much a month for this monitoring product or these scores? Why are you charging for that? You know, so I think credit bureaus in Europe are going to have to probably take some benefit from the model short term, but I think they're going to have to think a bit longer term about, is that going to be a revenue model anymore? And if it isn't, there are other ways of doing it, and that's what we're trying to encourage the debate as well. So yeah, I don't know if that helps.
Yeah, it does. To answer your question about how we've gotten the lenders involved in the U.S., it really wasn't us involving them, it was our regulator involving them. You know, the new Consumer Financial Protection Bureau in Washington has made financial literacy one of its chief priorities, and it's challenged all entities within the financial services world to do a better job of educating their customers about financial products and services. In this case, what we're talking about is credit reports and credit scores, how they use them, and how the consumer can have access to them. So the way we found a market there is the larger banks, even the mid-tier banks, provide credit monitoring and identity protection to their clients, but we're the engine for that. So it's branded with their name, but it's Experian or TransUnion or Equifax behind that engine, delivering this consumer education to and score disclosures to customers, sometimes for free, right? So they pay us, and then they provide the product to their consumers for free in many cases.
One issue that you pointed out very correctly is that most the issue we could have in Germany is that the banks will use credit bureaus as a front if they have a negative decision to do. So it's something we have to work with. It's very important. They're our contract partner. We need to be very open to the community and say it's not the credit bureau. It's a combination of the information we have at the bank itself, and we work in this one. I mean, I don't know. It's not a market. I would say look at Enrico.
I think that I can share with you the fact that credit bureaus sometimes are utilized as the excuse for denying credit by lenders. Then here the process is about, taking the compliance from customers and moving them to a service, as Tony and you pointed out. Example in Italy, we have 100,000 access to our credit bureau by consumers every year, because the regulation says that they can get every 6 months a free credit report. But 99% of these requests are angry customers because they try to get credit, they did not get it, and they knock our door saying, hey, show me my report because I want to better understand why the bank did not grant me credit, you know. Then this is the problem. We have to turn it into an opportunity. For example, what we are trying to do in Grief, anytime we get a call from an angry consumer wanting to get his free credit report for understanding what's happened, we try to convince him that he can subscribe a personal solution package, helping him to keep monitored the evolution of his credit history and understanding how he can improve his or her credit score. Then, you know, it's a process. It's a process.
Becomes an upsell opportunity. We're going to switch topics now after that one, and we're going to move to a new topic called around the issue of data quality and integrity. You know, I don't know about in your markets, but in the US, data accuracy and data integrity are kind of a chief regulatory imperative. And that is, the regulators believe that when reports are accurate, everyone wins, and they do. Credit reports have more value to lenders, and consumers get a better price on their credit if they're accurate. I think it's a virtual circle that has a real business imperative for us. So I'm going to ask Enrico to talk about some of the issues associated with data integrity and data quality from the perspective of what is the industry doing to meet greater demands for data accuracy and integrity. So,
yeah, Tony, thank you. I tried to fix the key content of my presentation in some slides. I do not know where I can find them.
oh, the lights.
Maybe you can help me. That one should be there somewhere. Okay. Okay, the point about data quality and integrity, we already discussed about this during our conference, is a point of confidence on our industry, you know, because if we are not able to grant a decent level of data quality, we are not reliable. The discussion sometimes is about is something which is are we speaking about self-regulation, or are we speaking about something which is in some way already fixed by the regulator, the point of data quality? The data quality issue has been already fixed by many regulators. Just a few examples. Okay, IFC, setting up the general principle on credit reporting. The general principle number 1 is about data quality and data accuracy. If we look at the EU data protection regulation issued in 1995 and currently under revision, we have a specific article which is ruling for all the industry, not only for the credit reporting industry, saying that information must be treated in an adequate, relevant, and not excessive manner. If we move to the US, the Article 607 of the Fair Credit Reporting Act says that credit reporting agency must handle personal data ensuring the maximum possible accuracy. As these are just examples to say that data quality is not a gray area, not already taken into consideration. Okay, point fixed. Who are the stakeholders when we speak about data quality? For sure, the regulators, data providers, then basically our customers, the other customers we have, which are who are the borrowers, and finally our industry itself. I do not want to go into the role played by each single stakeholder. I want to make some examples of problems we might face on data quality, also when we are 100% committed in ensuring the best data quality and data accuracy we can. This morning, Michael Ritter spoke about the unique identifier for companies. Welcome, because as we already pointed out this morning, this will facilitate a lot the process of identification and then matching of the information on legal entities, which is still a problem in some cases, despite the fact that we are trying to ensure the best quality on treating data on legal entity. The way in which you can write the name of the legal entity, myself and Tony, our directors, maybe are 7 or 10 different ways, and then sometimes matching is not so easy. When we speak about definitions, we do not have, for example, in Europe, still, at the time being, a common definition of default. Basel II introduced a definition of defaults which has have had till a couple of years ago some exceptions. Why? Because in some countries the definition, the general definition, was not applicable. Then when yesterday morning in a workshop involving some of you, we were discussing about standardization. The point we made was not about standardized a data format like Metro 2 format is standardized a taxonomy, in the sense that if I speak with an Italian bank, the definition of default is clearly defined, because this definition of default maybe is different from the definition of default a UK bank has in mind, and vice versa. Obviously, the European Central Bank is moving ahead, helping a lot in setting a common taxonomy. The Credit project, who many of you know, is going into that direction. But still, in Europe, we have differences. Another difference which is impacting on data quality is about the different kind of credit facilities we have in place. For instance, in Italy, the so-called loan, salary deducted loans are quite common. If you go to, I don't know, Denmark, and you ask if they manage into the credit reporting system there the salary deducted loan, they ask you, what are you speaking about? We have differences and we have to manage differences, having a significant impact in data quality, especially if we want to ensure the so-called cross-border credit, which is still 0 point something percent of the credit granted in a geography like Europe, but will increase more and more. Then, if tomorrow I will apply for a credit line in Germany, and Schufa, as the credit bureau inquired by the German bank, will come back to the Italian credit bureaus, asking for the credit report in order to be provided to the German bank. I am applying for a credit line. Otherwise, no information probably would be available from Schufa itself, because maybe I moved from Italy to Germany 1 month ago, then I do not have credit history in Germany. If I'm not able to clarify the content of my credit report coming from Italy, translating it into a language which is understandable by the German bank, theoretically the data quality of the report is granted, but it is useless because the German bank cannot understand the real meaning of that report. Then, theoretically data quality is granted, but in reality we have a report which is providing a poor quality in terms of information required. That's more or less all. I think that as an industry we are really doing our best effort in order to ensure data quality. Sometimes data providers are not so, I would like to be polite, on the same line. For them, sometimes granting a high quality flow of data is not their problem. Why? Because at the end of the day, the credit reporting agency will take care of it. But sometimes it's not so easy to transform poor data into rich data. Then, we have to work as an industry, in my opinion, more and more in order to educate our data provider that the data quality is key for them as well as it is key for us. We have to educate consumers about the meaning of the information we have. And by the way, we have to ensure data quality, otherwise, if we deliver to them reports with wrong data, that could become a problem for our reputation indeed. Last but not least, on data quality, we have to stay maybe more and more close to the regulator in order to explain them that they have to make things easy. A standardization of the credit reporting data model in Europe, for example, is beautiful theoretically, but it is not manageable in practice. Because there are still so many differences country by country. Much more better, instead of working on standardization, is working on a common dictionary, on a common taxonomy. Thank you very much.
Thank you, Enrico. That was very interesting. It's a business priority for consumer reporting agencies. One of the things that we're seeing in the US is this new focus on accuracy is driving regulators to force credit bureaus to be the disciplinarian in the ecosystem. It's a common regulatory exercise we see often in government. I'm going to call it the choke point theory. There are 3 credit bureaus and 10,000 data furnishers in the US. So the regulators are using the credit bureaus to get more performance out of the accuracy of the data furnishers or data providers. So that what that means is that we have to work with data furnishers to benchmark their data compared to others in their peer groups, demonstrate to them whether or not they're out of the normal range of data accuracy in terms of disputes and resolutions, and then coach them through systems and processes that improve their data accuracy. And over time, if we can't get the performance that our regulator is requiring of us, we have to take disciplinary action. This is really happening a lot in the collection industry space. That is, if the collection industry can't be more valid about the data that they're providing to credit bureaus, and that is largely the most inaccurate data that we get into the credit bureau, we're under an obligation to kick them out of the system if they can't come up to a level that's expected of our regulator. So that's putting us in a situation we've never been. That is kind of the disciplinary over the data furnishers in a voluntary system. It's not a role we cherish, it's not one we ask for, but it's certainly one that the regulators are demanding of us. Peter, how are data quality and integrity issues being addressed at SCHUFA?
Yeah, I mean, it's probably a little bit different in other markets. As we have a market leader kind of position on the German market, it means that we have to be very careful about the quality we have in the database. So last year we said, okay, we have to do something because we don't want to kick out customers if we have reciprocity. We need to have a high quality. We work very hard with the quality concept. The quality concept means that we will talk to a customer if it doesn't deliver the quality standards we have. And in the past we had a lot of discussion, we never had some actions. Now we have an action plan. It means we will have discussion. After that it will take some different steps. But at the end of the day, we really say to this customer, you have this time to fix your data, otherwise you don't allow to be in the system. And happily we haven't been forced to throw some out. But the concept could be that we do that. And that's really helping us because we have a very clear concept. You can discuss with the customer, your partners, say, this is the quality standard you have to deliver. I know how it is in other markets.
Yeah.
Same in Italy?
Well, we approached Peter this in a very, pushy way, including into the contracts we have with data provider, some kind of penalties to be paid when they did not comply with a minimum quality standard. The problem, as Tony pointed out, is that it's not so easy manage this because at the end of the day they are part of the game. Then you know what I'm saying. It's a much more an education process than a punishment process. We have to more and more develop.
Right, Lawrence, maybe you have some points of view about that too.
Yes, I think in Asia then the consumer transparency getting important. People are really concerned about how accurate their consumer report data are being reported. I was sitting in the board of NCB, so unfortunately every board meeting, I'm sorry, Paul, I have to share with everybody, there's always an hour spent on customer complaint. And basically some customers are actually taking the opportunity to ask for NCB to correct the data. If they're not going to correct data, then they will sue NCB to the court. So basically in this market, consumers are very concerned about how their data is being reported. In Hong Kong, the regulators is actually requiring the banks and also credit bureau to correct the data within a certain time frame. If the data correction cannot be done, then also there will be warnings and penalty to the credit reporting agency. So I actually agree with Enrico. The issue for us is that we have to work with the banking, with the financial institution, but it's just that we cannot really impose penalty on the banking, the customer, because they are our customer at the end of the day. So it's more an education. It's more a sort of like education to the data provider that you need to be accurate on the data, because the impact on the regulations, the impacts on the consumer. So it's an ongoing journey. And the other thing I also want to share with the team here is, in Asia Pacific, then I think the biggest challenge for us is really the national identity system. In some of the big markets, new markets like Indonesia, 240 million population, in India, and also in the Philippines market, they really do not have a proper national ID system. So the credit reporting agency really have to invest a lot of time and effort to build a search and match logic to make sure the matching is up to the standard, and make sure that it really is conducive to data accuracy. And this is really some of the challenges we are facing in this Asia Pacific space.
You know, one thing that occurs to me is all this talk about data accuracy and integrity and how much work we have to do in order to make sure that it's up to the level of expectation. You would think that credit data is grossly inaccurate, but I don't think so. As a matter of fact, I want Michael to jump in here because he's done some research on the accuracy of consumer reports, at least in the US market, and I'd like you to tell the audience what your findings were about that, Michael.
Sure, and I think it's important to keep in mind in assessing data quality. We've talked really mostly about two legs of a three-legged stool. We've talked about the CRAs, we've discussed the furnishers or providers, but the other leg of that is the consumers. And earlier studies in the US in the 90s and early 2000s, there were consumer surveys of data credit accuracy or credit report accuracy, came back with just astonishing findings that the error rates in credit reports from these research analysis were ranging from 20 to 70%. In fact, Elizabeth Warren went on National Public Radio at one point, citing the 70% error rate figure, which obviously if banks were receiving credit reports that had 70% error rate, they would have real underwriting problems. But having said that, this is taken quite seriously because it's repeated in the media, and it forces policymakers and regulators to take action, or at least be perceived to being taken action. And this culminated in our country in 2004 with the enactment of the FACT Act, the Fair and Accurate Credit Transactions Act, with a requirement for the Federal Trade Commission to conduct a 10-year-long study of data accuracy in the US. They had released a few pilots along the way that were very small sample size, so nothing statistically significant be read into it. But the media coverage of this, again, was inaccurate and distortionary. I know that's a shock to many of you in this room, but the reporting was on the consumer's perceived error rate. In fact, I say this because just at Madame Wong's event a few days ago in Xi'an, a lawyer from Washington, D.C. miscited a finding from the Federal Trade Commission analysis, the final report to Congress, saying that the error rate in consumer credit reports in the United States, as found by the FTC, was 25%. That was what consumers, when they reviewed their credit reports, perceived could possibly be an error, and that was both above the line, what we call header data, the personal identifying information, name, address, that sort of thing, that's not scored, and then the below the line data, the trade line data that could be scored. What the FTC study found, in fact, was that the error rate was far less. And they looked at what was called a material error rate. That means that if there were a verified inaccuracy in your credit report that were then subsequently modified, would the effect on your credit score be sufficient to move you into a better or worse risk tier? And that's really what matters, because you want accurate data to have your credit market standing accurately reflect your credit capacity, credit risk, and credit worthiness. So errors are material. That's what we're trying to fix. And that rate, the FTC study found to be slightly less than 2%. We ourselves did a study.
98% is an A on any test.
That's right. That's actually a very good point. So, of course, they wouldn't lead with saying that 98% of credit reports are materially accurate. We PERC actually conducted a study a year earlier, and it remains the largest assessment of data quality in the large repositories in the US that directly involve the consumers and the repositories. It was a methodology that actually heavily influenced the Federal Trade Commissions. In fact, in their report, their first annex is dedicated to our study. And our material error rate was less than 1%. And we actually went through the findings of the FTC's report because they looked at, there's a distinction between error rate per report or error rate per consumer. So we normalized that. And what we found is that the findings from the FTC's report were statistically identical to ours. And so we've shifted the national debate from asserting that the accuracy in the credit repositories was horrid and was 25 to 70% to ping-ponging now back and forth between less than 1 or less than 2%. And that's significant. And I would encourage, if you haven't undertaken this type of educational analysis, to work with your regulators and work with consumer advocacy groups in the media. It's quite an important contribution to do so.
Thank you. The challenge about data accuracy is that perfect is probably unachievable. And even with an error rate of 1 or 2% in a market the size of the United States, that's still 2 to 4 million consumer reports with material errors. So it's not that we don't have more to do, it's just how we focus, like we've talked about, how we can improve the processes with both a matching and with data furnisher discipline. So.
Tony, if I can add in my experience, we are under 1%, 0 point something. We have to be honest on the fact that there are, in many countries, including many European countries, for example, lawyers specializing in supporting customers in identifying the mistake in order to come to the court and ask for millions of euros or because we are speaking about 2%, 0 point something percent, okay, are anyway 100,000 cases because the overall 100% is very, but the reality is that the material effect is really, really, really minimal. There are a lot of people trying to make money on the desperate people not having the possibility to get credit because they are over-indebted.
Right. I couldn't agree with you more. As a matter of fact, we should all become attorneys and start suing credit bureaus.
And if you need an expert witness to testify on the accuracy of the litigation, please call me.
Yeah. Anyway, that was a really good dialogue on accuracy and integrity. Thank you so much. I want to switch the topic now to one that's probably more related to the Asia-Pacific realm than anything else, and that is just the issue of regulatory oversight of credit bureaus and what regulators are thinking the appropriate level of oversight is necessary in Asia-Pacific. And in order to address that, I've asked Dr. Parenas, through his experience working with finance ministers and central banks through ABAC and APEC, to give us his thoughts about what the expectations are of credit bureaus among regulators.
Well, thank you, Tony. Well, as I mentioned yesterday at the workshop, the part of the business sector that some of the people here and myself are involved with works with APEC in developing the enabling legal policy and regulatory frameworks for an efficient, effective, and sustainable credit information system, especially in the region's emerging markets. And I think Lawrence talked about it, some of the issues that face credit bureaus, and also a lot of the issues in Europe are also very familiar to us here in Asia. Why are we working with APEC? APEC is actually an excellent platform for doing this because its objective is to promote trade, investment, economic growth, and integration among 21 member economies. And this is a process that goes through the official level, the ministerial level, and the leaders. So there's a lot of political support that can be harnessed in order to get agencies and ministries to do things. There's of course a lot of other organizations, and sometimes the media of course puts more attention on the G20. So what's the difference between what the G20 is doing and what the APEC is doing? So I would characterize this as sort of a division of labor, although there are overlaps, but G20 focuses on the design, the architecture, but APEC is the one which really focuses on the plumbing. So it's like, if your toilets are not working, and you don't get hot water, and the central air conditioning system is not working, then nobody will want to live in that building. But APEC is working on the plumbing that underlies trade, investment, economic growth in the region. There are several ministries and agencies organized along working groups that hold altogether more than 200 meetings in a single year. The objective is to reach agreement, to learn best practices that countries can adopt on very technical issues. So, from our perspective, it's a very useful platform. And in addition, APEC, more than other international organizations, is very welcoming to the business sector in providing inputs. And a lot of the people here have been involved in dialogues with central bankers, with government people. Now, I also mentioned yesterday that one important issue, especially for this group, is that the APEC finance ministers last month announced that they created a roadmap to guide their regional financial market development effort over the next 10 years. And this roadmap is called the Cebu Action Plan, named after the city in the Philippines where they held their annual meeting. And at the top of the list of initiatives in this roadmap is the establishment of the Financial Infrastructure Development Network, or FIDN. And FIDN is a platform for public-private collaboration to accelerate the development of credit information, secure transactions, and factoring. This network will be formally launched this coming November 12 in Manila in the run-up to the APEC Leaders Summit, and BIIA and APCC are both supporters of this event. Now, I would say that this is just the culmination of 7 years of advocacy work that we in the APEC Business Advisory Council undertook with finance ministries and regulators. We had the support of PERC and IFC, and we also had active participation by several institutions present here, including BIIA, Experian, TransUnion, CIC, CRIF, DNB, and of course PBOC, CRC, which hosted one of our workshops last year in Shanghai. I would say that the general situation is very favorable, and that is because the development of credit information has very strong support from central banks and finance ministries. And the reason is that it is a powerful tool for financial inclusion and financing of small and medium enterprises, which is really one of the top priorities of governments in the region. And it's the #1 priority of APEC this year under the Philippines leadership. Credit information used to be under the radar of regulators' attention because it's a very technical issue, and it's not always in the news. But some people here, like people from the IFC, Jin Chang Lai, who's with us here, Tony Lithgow, and Michael Turner, Robin Varghese, and Tony Hadley, and Lawrence, who would remember the sessions we have had with central bankers, in the 2008, 2009, our dialogues with the CSEN group of central banks, and then in ATFF over the years. So, we really owe it to these people and some others who are not here for effectively making the case before regulators in the region that credit information is one of the solutions to the most often cited problem of the lack of access to funding of micro and small enterprises. the number one problem of MSMEs, and it comes out in so many surveys in the region, is their lack of collateral. Many existing and potential micro entrepreneurs don't even have bank accounts, not to mention any record of having applied for loans. So credit information, especially if it's based on full file and comprehensive credit reporting, which includes positive and negative, traditional and alternative data, can really provide a tool that lenders need to be able to extend financing to these types of borrowers. So this is the case that a lot of the people here and others have made before regulators. And that is why, because of this advocacy, the importance of credit information gradually became clear to policymakers. So in 2010, the APEC finance ministers, with the support of central banks, included the development of credit information systems as a key objective in their Kyoto Growth Strategy report to APEC leaders. And since then, its importance was affirmed by subsequent ministerial meetings led by the US in 2011, by Russia in 2012, Indonesia in 2013, and China last year. And this year it has become the topmost priority in the minister's 10-year roadmap. So this is the situation. I think it's a very favorable environment for us to really start working on providing that enabling policy framework. Now let me just talk about the next steps, because I wanted to also share with you what we are going to do. And we're of course inviting all of you. A lot of you are already involved here, but I want to invite all of you to participate in this process. The first is really to get the credit information subnetwork of the FIDN organized. Just to talk a bit on the structure, FIDN is an informal network that is a subgroup of the Asia Pacific Financial Forum, it's a platform for regional collaboration among experts from the public, private sectors, and multilateral institutions on financial sector issues. The APFF, it's a policy initiative which is owned by 21 finance ministers. So we report to the APEC finance ministers process, but it is managed by the private sector through ABAC. Very informal structure, open architecture, subgroups have a lot of flexibility and leeway within the general objectives that the whole APF has agreed on, which is for this group the acceleration of the development of credit information systems in the region. I'm the overall coordinator of the APFF, so I deal with the other groups that are working on capital markets, repo, derivatives, etc., long-term investment, insurance, pensions. But the Sherpa of the existing APFF credit information workstream, which will be renamed FIDN Credit Information Subcommittees Michael Turner, with Robin as his alternate. So please contact Michael and Robin to join the FIDN. Now, second step is to develop the 10-year work program on credit information that we will incorporate into the details of the 10-year Cebu Action Plan work program. The outlines actually have been discussed extensively. If you want to read the Cebu Action Plan, it's there. But we need to flesh it out in terms of concrete deliverables, timelines, components, and a funding strategy. And I think we had a lot of ideas presented in yesterday's workshop, and that can go into this. We had a discussion yesterday over lunch with a few of you, with Joachim and others. And one of the options we're looking at is to use the spring meeting of the BIIA as the venue for finalizing this work program and strategy, which means that we will need an initial draft from our Sherpas to be circulated to those who are joining the subcommittee, and probably several rounds of conference calls to develop that initial draft to be ready for finalization in spring next year. And then the third is to continue efforts at the individual country level. There's already a lot of work going on under FIDN, even before it has been formally established in the Philippines. And I think the Philippine Local Committee is already well on its way under the leadership of CIC and strongly supported by the regional and local IFC teams. So they've lined up, the major regulators, the SEC chairman, the deputy governor of the central bank, the undersecretary of finance, and the Department of Justice. And we have several bankers and experts in that group. So we will need to start building up interest in other member economies, and we hope that the launching of FIDN on November 12 will be the opportunity to discuss with other countries to begin the process. And I think in our program there's some of the other stakeholders in other countries from I think from Thailand, from China, who will be there. Now, there are a few challenges. One challenge is that while credit information is strongly supported by central banks, in many economies, we also need to get the support of ministries and other bodies that are responsible for getting the laws, policies, and regulations in place that are needed. And these are bodies that may not always be as enthusiastic on this matter as the central bank. So we will need to work on that. For example, in many countries, it's really the justice ministries which are important because they're the ones who draft the legislation that is needed. So we need to work on that, looking at the successful experience of the Philippines as one model, but adapting it to specific setups in different countries. And another challenge is in the area of privacy, which is very important in the context of cross-border data, which is one of the aspirational objectives that we've put in the 10-year Cebu Action Plan. That by the end of the 10 years we should be able to make progress on this. In the discussions we had with finance ministries, this was the major issue. Particularly in the case of Australia and New Zealand, who were hesitant to give their support because they could not support something that their domestic laws do not enable. And so this is an issue that will require a lot of dialogues, both with institutions in charge of privacy protection and with government agencies that can support the development of approaches that balance regulatory objectives with the objectives of facilitating the use of credit information and data to promote greater access to finance. And that is in the context of a region that is increasingly dependent on cross-border movement of goods, services, and people for growth. So there we are. This looks like what people would support as a way forward based on the discussions we had yesterday, but we would welcome any additional suggestions any of you might want to propose in this session.
Thank you, Dr. Parenas. When he talks about Sherpas that are helping get this through, he's the Sherpa of Sherpas, right? So he keeps moving this along and has done it on a continual basis over the last really 5, 6, 7 years. I think it's incredible that you've been able to keep the industry and APEC so interested in promoting this financial infrastructure. So thank you much. Let's give him a round of applause. We've got just a few more minutes, and I want to turn to our last topic, and that is one that I know we'll all find interest because every time it's mentioned, everyone perks up their ears and wants to listen. And that's the issue of credit risk, credit scores, and how big data applies to that, or does it? So that's the question. I'm going to turn that over to Michael. He's been doing a lot of thought, been talking to a lot of financial institutions, has been trying to develop some theories about the use of big data in credit risk, and I think he's got some interesting thoughts on it. Michael?
So I'm going to use the dais.
Okay.
Much taller than I am. A number of you were with us in Xi'an a few days back, and coincidentally my topic was big data and credit reporting. So in an effort to keep this fresh for you and not be overly redundant and put you in the back in the sleeping and snoring section, was it, Joachim?
Yeah.
I'm going to actually I'm going to speak to a number of questions that were posed to this group by the members of this group, and it covers a lot of landscape, but it's not focused specifically on big data. It's issues of credit risk scores and some of the policy issues that have come up in the States and in Asia Pacific. But one question was, should credit scores be made more transparent to the consumer? And it's a great question, and I would say in some levels the market is already taking care of this. You've got online educational tools that are generally excellent. They're not customized to an individual, they're generic, but they're very useful. These are tools like creditkarma.com, mint.com, and others. And if you haven't, and many in this room I'm sure are familiar with them, but if you haven't, I would encourage you to check them out. And the reality is that transparency about credit scores to consumers is a bit misleading. Most consumers really don't want to understand the machinations of the score. They don't want to understand the math and stats, the log linear and split log linear. They don't care. To Tony's point, to the extent that they're concerned about scores, they actually want concrete steps they can take to improve their credit score. And so also in the market has responded to this. I mean, the market, anytime there's an opportunity and someone can make money, there's a response. Well, Tony alluded to a product that they have released, they being Experian, called Credit Educator. And it's an online or web-based platform where an individual who wants to know how they can improve their score can register and have a conference or a call with an Experian specialist who will walk that person through their Experian credit report, line by line, answer any question they have, trade line data, header data, anything, and make sure they have a comfort level with all the contents and understand how their behavior impacts their credit score. And then that credit counselor will give them steps. We'll talk to them about their current financial situation and can you afford to pay down this credit card by $50 a month for the next 3 months, or could you open up another line of credit? And we'll give them things they can do to improve their credit score in the near term, typically 30 or 90 days being the near term. And we've done some analysis on this. We published a study with Arizona University, Michael Staten, a well-known scholar in consumer credit in the United States, that shows that the material benefits to the participants who've completed this process are quite impressive. However, in our country, the courts have interpreted a completely separate piece of legislation called the Credit Repair Organization Act, or CROA, that was designed to protect consumers really against scam organizations who were charging consumers to do for them things they could do for themselves or do nothing at all, but to help them improve their scores effectively. That anytime a consumer calls a credit bureau and says, how can I help my score, they're then subject to CROA, which means that the credit bureau can't help them right then. They have to give them a 72-hour mandatory waiting period. And they have to read to them this lengthy, nasty disclaimer that says, we're a big evil company and we're going to take your money from you and do nothing for you effectively, which doesn't really encourage people and give them confidence in terms of the uptake. So the consequence of this, between the nasty disclaimer and the mandatory wait, is that the uptake just it drops. Almost no one does it. And you can't blame them. But the reality is that this creates a fundamental tension with our decades-old Fair Credit Reporting Act, which recently was modified by the FACT Act, which puts the consumer relationship with the credit bureau front and center. There's an expectation that consumers will be receiving their credit report for free and will review the contents. And then there's an architecture in place for them to contact credit bureaus and now data furnishers to dispute perceived inaccuracies and resolve disputes. And now they're getting free disclosures. There's this real critical relationship between CRAs and consumers that has now a wedge driven in it. And so the takeaway here for regulators certainly or others thinking about this is to work with regulators to make sure that there aren't any barriers between consumers and CRAs that allows that really critical discussion about how can I improve my score? Because as a consumer, the most logical place I'm going to go is the credit bureau. So that's one issue. Another question is really, do regulators really understand credit scores? And is it important that that these scores be made more transparent to regulators? Well, I mean, do they understand it? In almost every advanced country, the answer would be an unequivocal yes. And they do. They have very sophisticated modelers on their own staff. They get it. For less developed countries, the answer ranges between yes and somewhat to not at all. So it really is a baseline for those where there are gaps in understanding and information, is that it is incumbent upon the value-added service providers, the FICOs or the bureau scores, the providers of the bureau scores, to work with the regulators to provide a fundamental understanding of what is a credit score, what are the variables, why do we have these variables and not other variables, and a core understanding of sort of how it works, again, without getting into lifting up the hood and explaining all the mechanics or the engineering. This is being done. We've been doing this with the APCC through ABAC and APEC through the Asia Pacific Financial Forum. This is going to continue to be done through the FIDN, and we've done this with the Asia Development Bank as well. So, these workshops in terms of getting industry with regulators and helping them better understand credit scores and how they work, and getting a more granular look at this is important and critical. Another question was that how can we assure consumers and regulators that credit scores are not being used to discriminate against certain protected classes? And to the extent that this ties into the big data theme, look, when we're using structured data, when we're talking about conventional credit reporting, it's a much more basic proposition. You don't include those variables, first and foremost. You don't include age and gender and surname or religious identity, those types of things that would potentially lead to a discriminatory outcome. But it's also easy to prove that you're not discriminating in variables in your model. When you get to the unstructured data, where you're beginning with thousands of variables and getting into transformed and meta variables and models with skills and these inferred relations, it's much more difficult to explain, and it's also more difficult to protect and determine that there is no discrimination coming out of this. And you can think of certain websites or behavior on websites that might be more preponderant to one group or another, and if that's involved in some scoring, there's a real risk. So the reality is that to the extent that big data is used as a part of a credit risk assessment, and this wouldn't happen because in more advanced countries, they have to comply with like the Fair Credit Reporting Act and explain quite clearly in a reasons code and demonstrate to regulators why this is being used as a predictive variable. It couldn't happen. But in emerging markets where there's a less clear or less well-established regulatory framework and there's more room for using big data, there's more of a risk of this happening. And so it's really at this point incumbent upon industry to monitor that and to make sure that it doesn't. So then this gets to the question of can we use big data in credit risk assessment? And this, there's really two parts to that. Is can we from a technical perspective, and then can we from a regulatory perspective? Obviously, from a technical perspective, the answer is yes. But the question is, are we using it as a substitute or a complement to structured data? And I think where big data works in credit risk assessment, or has shown potential thus far, for consumer credit, let me say, and it's different for commercial credit, and I'll get into that, is where it's being used as a complement to structured data, to thick and thin files or that sort of thing. I think there's a real risk at this early stage, particularly because of the obsession and hype around it, and a lot of money being thrown at it, and people under pressure to deliver quarterly results or generate revenue, to overpromise the value of this, that this is being used in ways that could be harmful. And I know an example, at least one example of a country that relied on psychographic or psychometric data, which is a form of big data, and use this almost exclusively in loan origination. And it resulted in a very bad outcome for that country. And so I think really until we see the market with the testing that happens in the market, lenders are by nature very cautious. They're not going to just take something without doing retrospective testing or live testing, small test and measured. It's not going to happen. But until the data gets out there, and research shows that this is a good complement to or as predictive as structured data, you're really unlikely, particularly in more mature economies, to see this being used in credit risk assessment for consumers. And Lawrence was one, you were raising your hand?
4 minutes.
Thank you.
Thank you.
3 now.
3.5.
All right. I think there's room for big data in where more experimentation will happen is in the context of commercial credit reporting, because you don't have all of the regulatory constraints. So sort of the second part of can we use big data in credit risk assessment? Right now, I don't see, and again, in mature economies, how you can, because I don't see how you can reconcile it with the governance structure. How do you provide notice and choice and access and redress? How do you work with the OECD Fair Information Principles? There's no way that I see right now. In emerging markets, on the other hand, again, where there isn't this governance structure, yes, it can, but just because you can doesn't mean you should. But in commercial credit reporting, you don't have the same constraints, and I think there's more opportunity for development and experimentation, the use of unstructured data for credit risk assessment. And then finally, I was asked to talk or opine a bit about should regulators discern between bureau scores and proprietary lender scores, and what is the difference? Look, frankly, given the ubiquity and the longevity of bureau scores, I mean, FICO and Vantage score in the States and FICO worldwide, it really puts them in a different class. And so, it's certainly appropriate that they're subjected to the scrutiny to which they are, and they have to explain what they need to. In terms of the bank proprietary scores, it's a little more difficult to make the case that that's as necessary, because really when you're asking yourself, why are you being subjected to scrutiny to the regulators? It's about, well, performance of the model and making sure that there's no discrimination that's resulting from the model. And banks themselves are subjected to intense scrutiny from bank regulators and others on those grounds already. Fair lending compliance, making sure there's no redlining, their portfolio performance is assessed, for capital adequacy and provisioning requirements. So they're kind of already monitored on an outcomes level. So it's really not necessary to my mind at least, have the same degree of scrutiny on the proprietary models that the bureau models are. I'd certainly open that up, or any of these questions up to my colleagues or those in the audience, but I'm, a minute left? So I actually was also asked to say 15 seconds, a few words on alternative data, which has been subsumed under big data. And really the question is whether or not there should be, one question that was asked was whether there should be a reporting mandate. A number of people yesterday discussed challenges in accessing the non-financial data, the utility data, M&O data, and so forth. and whether there are incentives to facilitate the sharing in the face of these challenges. We've done some research in the United States working with some major trade associations, the Edison Electric Institute and the American Gas Association. And we surveyed their members that reported to credit bureaus fully and stopped, that were reporting to credit bureaus, or that haven't reported. And we looked at why they decided to stop, why they weren't, and what was the impact on their firms. And what we found was that those firms that fully reported to credit bureaus, those electric, gas, water, telco, and communicated the fact of reporting to their customers, they saw tremendous benefits in terms of cash flow. That when their customers understood not just that if they don't pay, they're going to have a mark on their credit report, a negative, but if they do pay, they can improve their credit score and their benefits associated with that. Very quickly, not only did delinquencies and charge-offs decline dramatically, but people were paying more rapidly. So there are actually real benefits and incentives to engaging non-financial institutions and motivating them to share data with traditional credit bureaus. Now, in some cases, to galvanize the market, it might be useful for the government to intervene. Many utility companies and telcos are actually government-owned. So to the extent that the government can sort of lead by example and have those publicly owned companies fully report, that might be something very positive to do, and that would be one way I would recommend. So let me just stop there and just turn it back over to Tony.
Okay, great. Thank you, Michael. I'd love to turn it over to the audience for questions, but I think we're out of time, aren't we? So we've got to call it quits. Help me give a hand to this panel for their good work.